Hi, I'm James Robinson, and this is my stock pick of the week. This is the final video of my series on the company Value Line. Today we're going to talk about the company's wealth creating characteristics. So as I talk about every time I do an analysis of a company, one of the things that I like to look at is how good a job the management does at creating a company which is worth more and more money to us as an investor. There's lots of tools that management can exercise to do that. One of the things they can do is to buy back shares. The impact of buying back shares means that I will own a larger percentage of the company than I did before the buyback of shares. I also therefore get a larger share of the profits. I should therefore also get a larger share of dividends. Buying back shares is a tax advantage way of benefiting me, the shareholder, because when the company buys back shares, I get this larger chunk of the company, bigger dividends, bigger share of the earnings, and I don't have to pay any income tax on any of that. Whereas if the company pays me dividends, I do have to pay income on it. This way they don't have to. So when you look here at the shares outstanding, you can see since 2010, there's been a steady decline in the number of shares outstanding. That means the company has bought back a number of shares every year. It hasn't been tremendous. They bought back about 5% of the company in 10 years, but it's 5% of the company I wouldn't have owned otherwise. It also seems to be relatively constant. I like that the company's doing this. I give them a 4 out of 4 for this. I like when companies buy back shares. To put the share buybacks in better scale, better way to understand, if you'd owned 10% of value, which is Value Line, at the end of 2009, you would have owned about 998,000 shares. That's what 10% of the company would have been. So many shares you would have needed to do that. Today, through stock sales, your same 998,000 shares would mean that you have gone from 10% of the company to 10.347% of the company. So it's about a 3.5% increase in the value of your holdings in the company without spending a penny. And during that time, you would have seen the stock appreciate, and you would have seen some dividends, et cetera, et cetera. To put this in perspective even better, in 2010, if you'd bought it, the company lost $23 million. 10 years later, the company has made $15 million last year. So that's a $40 million change in the fortunes of the company over those 10 years. And during that time, you've had your ownership increased. So looked at another way, your earnings per share would have gone from negative $2.32 to positive $1.62, which is very, very significant. Another thing that I like to look at is stockholders or shareholders' equity. That's simply the amount of assets that the company owns minus the amount of debt that they have. And I believe that a good, healthy company will be gradually increasing the shareholders' equity as a result of growing the business and et cetera, et cetera. So you can see here that in 2009, the company had stockholders' equity of, I don't know, maybe $30 million, and today it's maybe $60 or $70 million. So this company's shareholders' equity has increased virtually every year, which again is just another sign. Also, it's increased gradually. So the company's not hoarding cash, they're not keeping money, they're doing a great job returning money to us in the form of dividends, where they give back 50% of their profits in dividends. They're giving some of what's left in the form of share buybacks. So even though they're taking good care of us as the shareholders, they are continuing to grow the value of the business that we own. So this is a really, really nice thing to see. This slide looks at the benefit of buying back shares. You saw that we have sort of a gradual increase in the amount of shareholders' equity per share, or per total shareholders' equity. But when you look at that shareholders' equity per share, you see that it's actually gone up more dramatically. And the reason, of course, is because there's less shares every year for the same amount, and even for a growing amount of shareholders' equity to be divided out over. So we've gone from about $2.50 in shareholders' equity in 2009 to about $5.50 this year. So it's effectively looks like it's doubled, and that's despite the dividends and money spent to buy back shares. So that's wonderful. As a shareholder, I like to see that. There's the old saying, it takes money to make money, and that's true. But as an investor, I don't mind that it takes money to make money. I want to know how much money you're making off the money that you're taking. So we talked about this company's shareholders' equity, which is growing every year. I only have a problem. I only like when a company is growing its shareholders' equity if they're able to continue to get a good return on the money of mine that they're keeping. So the way we look at that is return on, there's two ways we look at it, but one of the ways we look at that is return on assets. So you can see here that the return on assets for this company in 2011 were, call it 11%. They were maybe it's lower than that, maybe it's 5%, but The return on assets for this company every year since 2011 has gone up. And you see the green line represents what would be in the top 25% of companies. Company's always been above that number, which means that I'm interested in it. But really since about 2016, the company's been in the top 10% of companies, and that number continues to grow. So we have this great return on assets, this fantastic return on assets. The company doesn't keep a lot of money and isn't growing that asset base very quickly, but they're doing a fantastic job of making me profits off of the money that they're keeping. And that means that I don't begrudge them, or should they want to keep more, I'm going to presume they're going to continue to do good things with that money. Return on shareholders' equity is to me a much less valuable piece of information than return on assets. If you remember, return on assets is how much cash and other assets are you keeping as a company, and what are you doing with it? Return on shareholders' equity is a look at how much cash you have minus the amount of debt. And so your return on shareholder equity can really spike up if you use a lot of debt. And you know that I don't like companies with debt. So return on shareholder equity is a less important thing to me. Having said that, and despite the fact that the company has virtually no debt or has no debt for most of this time period, they're able to get a return on shareholders' equity, which is still in the top 10% of all companies. And that includes all those companies which are margined and levered up to fantastic levels, and thus that have tremendous risk. So we have much less risk than the people who own stock in those other companies, and we're getting the same kind of return on the equity that we do have, which just shows you the management of this company is doing a really, really first-class job. And so as a shareholder, if I can have great management, that's half the battle. So before I go any further, everybody running a YouTube channel is looking for subscribers. I'm no different, and I'd love it if you would subscribe to this channel. I'd also like it if you would hit a like for this video, and if you would comment. In addition to that, I have been charting where my subscribers are who have told me where they're from. And so I have this map that I've made up of where my subscribers are, and you can see this map here. If you like these videos, and especially if you invest and make any money on these videos, I'd appreciate it if you'd just in the comments write, you know, what city you're from. I'm in Belgrade, or I'm from Rome, or I'm from Johannesburg. I don't have any followers from Africa, so if you're from Africa, I'd love to hear from you. But just I'd like to know what city you're from, and then I'll put it out on the map for you. I don't disclose or announce to anybody, you know, who's from where. I just put a dot there. Finally, if you want real-time information when I do things, the way to get that information is on Twitter. I oftentimes take some time to make a video just because I'm busy, but whenever I buy a stock or sell a stock, I will put it instantly on Twitter so that you know what I bought and at what price. Also, I'll put articles there that I think are interesting, or when I make a new video, I'll post that on Twitter as well. So feel free to, I'd love if you follow me on Twitter, and my handle is @RobinsonStocks. One of the things that we talk about, or I think about, I look at with a company is retained earnings. A company has a bunch of things they can do with their profits, right? They can pay it out to me in form of a dividend. They can buy back stock. They can pay down debt. But one of the things they can do is reinvest it in the business. And broadly speaking, that's called retained earnings. They're keeping the money instead of giving it to me. They are retaining it for use in the business. And every company does that to some degree. Some companies need a tremendous amount of retained earnings. Those are not very attractive to me unless they're able to generate fantastic returns on that money that they keep. But every company needs some amount of retained earnings. The great news about this company, Value Line, is that it needs very, very little in the way of retained earnings. It's retaining a little, but as you can see, it's very, very gradual. That's important because you're going to see on the next slide, this company doesn't do a very good job of getting a return on those retained earnings. That doesn't surprise me. I think a lot of things they're investing in are kind of things wearing out that they have to fix and replace, which maybe is an oversimplification. But the fact is, I'm not sure they're investing this money into mergers that are going to grow the bottom line, or you know, they're not buying newfangled machinery that's going to make them more productive. They're really investing that money in things that aren't very productive. And so it could even be argued that they're losing money on some of this money that they're retaining. It looks like that they are, but I don't care. It's such a little amount, and in the aggregate, the company's doing so great on both return on retained earnings. Doing so great on return on assets and return on equity that I will begrudge them. You know, I won't begrudge them the fact that they have to keep a little bit of money to reinvest in the business in ways that aren't profitable. That's sort of okay with me, especially because they're investing so little. So this company does a great job returning money to me, and if this is part of the price of that, I'm okay with it. One of the things that a company does that in theory creates value for me as a shareholder is to retain some cash. Cash is king. Cash allows you to survive things like pandemics. Cash allows you to gobble up great opportunities, buy great companies when there's great opportunities, or buy a piece of real estate to house your office in if that pops up, or to pay a bonus to a person you really want to keep, or any one of 1,000 things. I don't have a problem if a company keeps a little bit of cash on hand, and in this case, the amount of cash on hand is growing. Again, it's growing very gradually, but the company continues to get great returns on assets and returns on equity. So don't begrudge them keeping. In fact, if they could continue to get these returns on equity, I'd want them to keep even more money in cash. I'd have no problem if they were to stop paying dividends entirely and stop buying back stock, if they could continue to get outsized returns on the money that they didn't pay us back. So these companies does great. It's not very much money, but it is growing, and it is a sign that the company is both healthy and very well managed. So this is a slide that I created, and I'm not completely sure how accurate it is, but it allows me to kind of to visualize things. There's a number of things that a company can do with their profits, and those things in theory generate benefits to me, the shareholder. So they can either borrow money or they can pay back debt. And if they borrow money, in my mind, that reduces the value of my company. If they pay back debt, in my mind, it increases the value of my company. They can pay dividends, which while it doesn't increase the value of the company, it increases the value of me as the investor. So I look at that as wealth created for me. They can buy back stock. Again, that's a reduction in cash for the company, but it means I own a larger percentage of the company. I did it in a non-taxed way. So I look at that as creating wealth for me as a shareholder. They can hoard money and keep it in cash. Again, I think that increases the value of my company. It makes it more stable, less risky as an investment. It means they can jump on opportunities if they need to. So to some degree, keeping cash is great. I don't have a problem with it. And so when you look at those things, I say, okay, what is in each of those four categories, what's happened? And then I say cumulatively what's happened. And so the line in orange is the cumulative wealth created for the last 5 years. You can see that for the last 5 years, they've created significant wealth, but it's been, and maybe let's say it's in the range of 20 or 30 million a year. And you can see this has been pretty consistent. So this is a company, I don't think we're gonna get, this isn't Tesla, it's not Apple, it's not Microsoft. We're not gonna have this company double every 12 months in value, but we don't need that necessarily. This is a slow growing, very solid company that's in a business that's not likely to change very much. And so I love this company. I think it's a good opportunity. And so that's the total wealth created for this company for the last, 25 years. So that does it for the value line. The last thing that I always do in the wealth creation is I talk about what I've done, what my portfolio is, and what I'm doing to create wealth for myself through my investing. So this is a look at all of the stocks that I currently own. You can see here when I bought them, to how long I've owned them, what my initial investment was, the purchase price per shares, the number of shares, and today's price, what profits I've made, etc. And when you look at this, you see that we've done it looks like I've done very, very, very well this year. But if you look at all of these stocks, I think I bought all of them no later than early March. I had sold a bunch of stock, slide here shows you where I currently am. I've been basically 50% in cash since April, actually higher than that. I was 75% cash in April and have gradually bought shares that have found things that were really undervalued. It's hard to keep up with the S&P 500 when you're all in cash, or you're 50% or more in cash. The S&P goes up, I'd have to go up twice as fast to keep up with them because I'm getting no return on my cash. But the upside of that is I've avoided, I've slept at night because I really believe this market is, for the most part, overpriced. One of the things to think about when you look at this slide, which is what I currently own, is I think my portfolio is in the healthiest position it's been in since we've started doing these videos together. Because I think I own, 5 of the 10 best companies that I've looked at prices that are extraordinary. and I think I'm gonna own those stocks for a very, very long time. Those stocks are SEI Investments, Paychex, Ventas, BlackRock, and T. Rowe Price. I think that all of those stocks are great companies that I'd like to own for a very, very long time, and I bought them super, super cheap. And even though in some cases, I think, Ventas, for example, I'm up over 100%, I don't have any interest in selling these stocks. I really do want to own these for a long time. Some of the later things that I bought, Value Line, Altria, and Westwood Holdings, as well as the Children's Place, those are probably more likely short-term holds. I'll buy them, and I say short-term, less than 2 or 3 years. I would be not surprised if I was to see these stocks go up 20 or 30% and I was to sell them. So that's where we are with the portfolio so far. Things are looking up. We are in the red, we are in the black for the first, maybe the second month this year, which is great. I suspect that will continue to be the case. And that's it. Thank you very much for your time.